Welcome to Powerhouse, where we interview the biggest names in housing and ask them about their strategy for growth. I'm Diego Sanchez, president of HousingWire. My guest today is Justin Messer, CEO of Prosperity Home Mortgage and a true powerhouse. Justin, it's so great to have you on the show.
Hey, thanks, Diego. Nice to be here.
Congratulations on recently being ranked by J.D. Power and Associates as the #1 mortgage originator for customer satisfaction. Can you tell us a little bit about your journey to the top in terms of CSAT?
Sure. Well, I'd be remiss to say if the shift in volume from refi to purchase didn't help us. I've heard it overall. Hey, the CSAT scores came down a little bit, looking back from like 2-3 years ago. And the bottom line is purchase is just really hard to do. And I think as part of that, expectations versus realities from consumers is a little bit tougher. But we are the best at doing purchase. That's what we core believe. That's how we built our model, and that's what we are. So, we felt confident with kind of the pipeline shifts almost exclusively to purchase. Now, I mean, obviously, 10, 15% refi, whatever that is, maybe a little bit higher, in some folks' case. We felt like that was really going to favor us because we know that we can execute on the experience, better than most.
Yeah, tell me a little bit more about how you're the best at purchase. How do you differentiate yourself from a bunch of other lenders that talk about their value proposition when it comes to purchase mortgages?
Yeah, well, let me start with kind of J.D. Power in and of itself. To focus on that is really one around the edges. So, the vast majority of the top 10 folks who you see in that all produce great customer experiences, right? But the value of getting to the point where you are actually counted in the survey, which means you have to hit like a certain volume threshold, essentially. So you got to be big for starters, but then you have to have hit enough survey responses in order to see it. As you dive into that rich, level of detail that they provide you in data around the responses, I think you're able to really dial in your experience. Like for us, a few things that came up, because we were 4th last year and then we moved to 1st this year. That movement, I'd say from 4th to 1 really came around really, really small areas. So, you get a feedback set that says, here are the things to focus on, right? And one of them was some of them surprising, some of them not so much, right? So, one thing that came back was borrowers said, we didn't get the frequency of updates and communication that we expected, which absolutely blew my mind. So I step back and we call this kind of all hands on deck meeting, this conversation to say, what the heck is going on here? Why is this a case? And, what we really found out was our, loan officers were over communicating with their realtor partners and under communicating with their actual borrowers, right? So it's this concept of who you view as the customer, right? And, when we built Prosperity, we were built out of a real estate company, right, called Long and Foster out of the Mid-Atlantic. So we focused and built everything, every process we designed, every process we redesigned, every vendor we interact with. We always think of it in terms of how is it going to impact the realtor and the realtor's experience in addition to the borrowers. So that was a really interesting moment where we had to think about, okay, how do we focus more of our communications, more of our updates, et cetera, to the borrower in addition to just the realtor. That was a little bit of a weird one. Second was kind of expectation setting. So there was this metric that came in that said, this wasn't a huge number, but a high percentage of our customers felt like we weren't meeting their expectations in terms of timelines. And you took that and you said, okay, us versus the top five industry companies. That's what you're compared to when you're in the top 5, right? We were closing loans on average from app to closing 2 days faster, but our borrowers were saying or ranking us significantly behind the peer group in terms of the meeting expectations, which meant our people were just being way too aggressive when they set expectations, right? So, hey, totally understand it, but it's okay. An 11-day closing is fantastic. We don't have to tell them 7, right? And that was the kind of thing. And then, so those were kind of soft behaviors that we had to correct around the origination for us to get there. And then, another thing that would come in would be, handoffs between team members and roles. So when someone's getting passed from, say, a processing role to an underwriting or underwriting to closing or MC to operations. So, we solved that by really focusing on the customer journey. So what do we do in terms of focusing in on, better identifying to the customer that they're now interacting with a different team member. And we did that through videos. So videos along their path, their journey, right? And having maybe the team leader of the processing team that they're going under and the closing team leader and underwriting product manager, all giving a quick video with their contact info, saying they could come out to them. So, that's really about JD Power specifically, because I know a lot of people had questions around that and like, how the heck do you do that? What does it look like? What's the value of JD Power? How rigorous is it? So that's kind of that. If you want to rewind and just have me talk about prosperity in general and our view of it, I'm happy to do that as well.
Yeah, I'd love to stick with JD Power for just another question or two.
Sure.
How do you, it's really tough to repeat as champions in sports and probably with JD Power as well. Did you get feedback that you're going to work on for 2025 so that you can repeat as champion?
Yeah, I mean, it's stuff really, really specifically around the edges. And one thing that I think we continue to work on is really that handoff between roles. That seems to be the one spot that shows up consistently for us as we're still a little bit unclear. Now, fortunately, we just rolled out our journeys in the fourth quarter of this year, right? So the journey updates with the videos and the handoff. So we're really hopeful that is what moves it forward. Luckily, when you're at the top, there aren't really all that many things that you're hitting. Again, our ability to solve problems is fantastic, but a few too many problems arise in transactions in general, right? So that's a whole question of, hey, problems arise in purchase. It happens all the time, right? But we're able to solve them quickly. Can we reduce the incidence of problems, off the bat? Those are like the small things I think that we're really, really focused on, but nothing real major this time. Fortunately, this year's data set, came out pretty clean for us.
That's great. So yeah, let's talk a little bit more about how Prosperity is unique. You have a little bit of a unique ownership structure and a little bit of a unique way of doing things. So maybe walk us through that.
So we're a realtor affiliate model, and what that means is about 2/3 of our purchase business comes from owned real estate affiliates that we have. So in other words, in major markets, we own usually the top 1 or 2 real estate brand in that market. And our loan officers service those offices and those real estate agents, right? So again, being owned by a realtor, we are a little bit more of a captive model. But again, I would say what really differentiates us is that we were built by that captive model. So we were built strictly to be a purchase lender, even though we do plenty of refi. We did 55% of refi in the height, right? But our focus really is around that purchase transaction. So what that allows us to do is, I would say, focus on the gravity of the transaction. So if I think about, past lives where I was primarily refinance focused, transactions were a little bit more of a conveyor belt, meaning if one fell off and one went by the wayside, it had limited kind of, I would say, domino effects throughout the rest of my business. When you are a realtor affiliate, the standard that you're held to is very, very high because realtors have an office, and that office is kind of like their community where they exist. If I mess up a transaction inside that office, any transaction, regardless really of who's at fault, but especially if I'm at fault, that has such a domino effect in terms of the morale and the willingness to trust prosperity with the transaction that, again, the stakes are just significantly higher when you're kind of the captive. And I would say, when a realtor refers a company that is also affiliated with them, they feel like they're risking their reputation and putting their reputation on the line in a huge way. And the financing is part of that reputation. So again, I think we just approach transactions, especially purchase transactions, in a materially different way from the rest of the marketplace.
So what percentage of your originations are part of that captive model? And what percentage are just your LOs going out and winning business in the marketplace?
Yeah, so it's 2/3, 1/3. So okay. 2/3 of our purchase business is affiliated. 1/3 is unaffiliated, meaning going out there, whether it be self-sourced, whether it be past relationships as we've hired folks in, or whether it be agents who've left us. That's also a big source of business for us. They leave us in terms of on the real estate side, but they don't leave Prosperity because, again, what's the value add that we provide to them, right? It's a trusted partner and it's a superior process, someone they can trust their client with. That's really the only thing that we can add, and that doesn't change based upon where you hang your real estate license.
So you came up through capital markets to become CEO of Prosperity, and that's a little different from a bunch of other IMB CEOs who came up through production, through origination. What do you consider to be the pros and cons of your capital markets background now that you're the CEO?
Yeah, I mean, I'd say not really many cons. The original difficulty, I'd say, and hurdle to overcome, right, is convincing people that you are a sales first leader. And the natural inclination when you come up through anywhere outside of sales is if you haven't produced, you don't understand producers. And I think the core of there's two types of people that exist, right? Salespeople and non-salespeople. The vast majority of people are salespeople, regardless of what they do. If they're decent at what they do, they're always kind of pitching something, selling something, winning support, building consensus. That's building coalitions. That's what I've done my whole career, whether you're in trading, whether you're in investor relations, whether you're just dealing with loan officers on the lock desk. So I think that was step number one was, having people understand that I have empathy, right, for what they have to do and what they have to go through. I have been on the road for thousands and thousands of hours, sitting, co-officing, talking to agents, talking to realtors, understanding the relationships. And then, for me personally, like I would say the first few months that I was on the job, I got sat down by a very senior guy in capital markets, and I was just complaining about, whatever it was, loan officers locking in before the market moved, or we hadn't repriced or something. And he said, hey, you're not going to make it in this business unless you sit down and you realize no loans, no jobs, right? So production is what drives this industry. It's what drives this business. Empowering originators is, how we put people in homes, how we successfully meet our missions. And, it's really my job, leadership's job, the back office's job to support production, right? And remove any hurdles or roadblocks they have. So as long as your folks, I think, know that you're trying to iterate and innovate, they know that you have your kind of finger to the pulse of the industry and that you're trying to remove roadblocks from them, they're going to support that. Coming from the backside of the office or back office though, or the other side of the business though, also kind of really, really, really made it simple for me to build that bridge between everyone else and sales. The thing that I still don't understand why it exists in our industry, and I hear it when I talk to LOs at other companies and I'm interviewing them, is like there's still this separation between the two sides, of the organization, whether let's just call it simply ops and sales. And sales thinks that ops is always out to get them. Ops thinks that sales is always out to defraud them and trick them. And it's a very weird dynamic, and one that I think we have really, really broken down at Prosperity. And I think actually my background really helped in that, because we're able to simply say, hey, we are out for one thing and one thing only, and that's the best interest of the customer. And then we define our customer very simply, depending on where you are, right? For our operations team members, right, our customer is naturally our borrower. It's also our realtor partner. And then it's our mortgage consultants, which is what we call loan officers. So reframing our mortgage consultants as customers of operations, I think really, really changed kind of the interaction that we had. And I think I was kind of able to do that because I had the trust of our back office as well, knowing that I had their back and I was supporting them just as much as I was kind of our production force as well.
I imagine that the affiliate model requires you to recruit a certain kind of LO to be a mortgage consultant at Prosperity. What do you look at when you're out there recruiting for the next LO that you want to bring into the organization?
So I think there's a old world view of this and a new world view of this, right? I think the old world view, was kind of a tired and lacked innovation, lacked creativity, lacked thought in terms of what that LO would look like, because that LO would sit in an office. And in that office were 150, real estate professionals, of which 40 did significant production, 30 did significant production, and 120 kind of hung out and walked into the room every single day and sucked their time away from, I would say value add and, more important, income adding, production and efforts. In today's world, we don't necessarily view a real estate office as an office. There's still a very specific LO who thrives in an environment like that, wants to sit in the office, wants to be part of that ecosystem, is the heartbeat, and it's very, very successful. in that environment. But even the most successful loan officer that I put in an office with 50 people, guess what? There's going to be 20 people who just don't mesh with them, right? They don't have the same style. They don't have the same personality. They don't have the same interests. No matter what, they're just not going to work together, which is why we have a tendency to view our offices more as what they are, which are communities of agents. Okay. So we have a community of agents. We have a tribe of agents, right? They're loosely knit together, right? But they all kind of are part of, let's just call it the same basic ecosystem, meaning they still meet face to face. They're in the same markets. They have the same problems. They have the same challenges. But I grab an outside loan officer, for example, who's doing $25 million, $20 million of production. What I'm able to do is bring them in and say, you know what? I'm the best purchase lender in the country. I'm going to take your outside business from 20 to 30, right? Because your process is going to improve so dramatically that word of mouth from your current referral sources are going to expand outside at whatever realtor you want to call it. And then I'm able to take, and this is the primary function of my sales leaders, right? I'm able to understand your personality and what you're good at and how you operate. And I'm able to match make you with agents within these communities, right? Who currently maybe don't necessarily jive perfectly with the loan officer who's supporting that broader market today, right? And I'm able to take that 30 and make it 50. So I can move people to be from, let's call it a very relevant local loan officer to the top 5 loan officer in an individual community overnight. And that's really the focus of where we're headed. And, that's a big reason why JD Power is important for us, right? Because it breaks down those doors and it's an external validation of kind of who we are and the value that we add. Because we can sit here from the top of the, scream it from the top of the rooftops. And Diego, your exact concept is what people come back to us, which was like, hey, you're a captive model. I just need to sit here. And I say, well, I'm not really a captive model. I'm just the best purchase lender in the country. Mm-hmm. So you can do this and wield this tool however you want. If a loan officer wants to be strictly outside and have nothing to do with our relationships, we're not going to stop them from talking to our agents who they, already have relationships with or want to do business with. But we're also just going to empower them to be outside loan officers and supercharge their business in every single way that we can.
So being the best purchase lender in the country makes a lot of sense in a purchase market. But I wonder what happens when rates fall below 6 again, get into the mid 5s, and we see another refi boom, which could happen in 25, could happen in 2026. Do you want to get some of that refi business, or do you still stay focused on purchase?
I mean, absolutely. We acquired the assets of a direct to consumer model last year for this exact reason, to kind of level up our game there. Listen, our retail loan officers, they're actually pretty good at protection. And I say pretty good from a distributed retail perspective, which means, just over, I think it's 28% are what we get back in, right? Not great, but not the worst, right? So we look at that. But the question is, when rates drop like that, here's what happens. Our realtors start to get ignored by their other partners because their other partners are so focused on their refinance business. So what I really want our successful distributed retail LOs to do is dig the moat deeper in their agent relationships and focus on purchase, which is why we try to partner and allow our direct to consumer group through a client loyalty program, originate a good percentage of those refinances, which is their specialty. Let's be honest, asking a mortgage consultant or loan officer to specialize in purchase and in refi is a little bit more difficult, I think, than they're willing to admit from time to time. Some are very good at it, right? Some are ultra, I would say they have process in place. They have systems in place that allow them to do that. The vast majority, though, are better served to focus, double their purchase volume in those environments, and then allow someone else to take care of their refi where they get compensated a little bit for it, right? To take that off the plate. And then we keep them in the ecosystem, right? I think our focus certainly is around the refi transaction from the standpoint that, we want to keep in touch with people, keep relevant in their home ownership experience, because our biggest fear is that the next time they go to, let's say purchase a new home, an investment property, a second home, that we're not top of mind for them, right? And, I would also say that when we talk about refinances, if you do a fantastic, unforgettable job on the front end, right? That borrower is very, very likely to either come back and contact you, or at least if you come in and you know that it's happening and give a second opinion, they will certainly listen to it. That's something that we've certainly learned, as we've rolled these programs out.
So big focus on purchase and really delighting your customer during that transaction. how do you think about servicing? Because servicing is an area that you can either come up short or again, delight your customer. Do you outsource that? Do you sell off the originated loans to to a servicer? Like how do you think about servicing at Prosperity Home Mortgage?
Well, let's start by saying, we are, our parent company and structure, are some of the best capital allocators that have ever existed in Berkshire Hathaway. As such, currently, you know, they aren't willing to allocate capital to us for, retention of servicing. Instead, they do want us to be a service release shop, which, hey, we fully respect and we understand. And you don't begin to second guess the best in the business, right, around what's happening currently. And again, it's a tough thing about all companies. Like if you're mono mortgage, I think you should be retaining servicing nonstop. When you're a company with, let's call it 700, 800, 1,000 different avenues to allocate capital, that's where it gets a little bit tricky about, hey, what's the highest and best use? For us, I think retaining servicing would be the natural core of our business, right? The center of the plate, and the most important piece that we could to maintain home ownership. Home Services of America, which is our parent company. I mean, really, what's our goal? Our goal is to be a home ownership company, right? So we want to take you from originally shopping for a house. We want to start you in our portal. We want to talk about, hooking you up with the right agent. We want to talk about mortgage, title, insurance in the right markets, moving in some markets, HVAC, like you name it. We want to be there from the beginning to the end. We want to be there for, the entire, every transaction that you make, right? Mortgage servicing seems to fit pretty naturally into that as a central, business line for us. But hey, we don't do it today. So alternatively, we try to focus on partnering, I would say with servicers who, have aligned incentives with us. I think it's a little wacky to think that you sell someone a cash flow, and then you get mad at them for protecting that cash flow. I think that we're a little bit missed on that, and we've kind of changed the logic on that. Maybe that's coming from my background in capital markets, right? So I'm like, I don't know. I love that it's a fist fight today, right? And I'm okay with that fist fight. The thing that concerns me the most about not retaining our own servicing is kind of all of the propensity modeling that's going on all of our consumers on the back for the next time when they might purchase a home, right? So, again, what we try to struggle with and what we try to partner with our servicing partners around is all day long, the refinance is a fist fight back and forth between the two of us. We understand that. If our relationship from the initial transaction wins out on that versus your relationship as a servicer, hey, that's fair game. However, when the purchase comes around, our attempt is to ink deals that are mutually beneficial in terms of, hey, if they get to that before us and they see it, that they'll let us know and we'll work with them together to try to surface that purchase and deliver it back to either the original real estate professional that was on the transaction, or if they're out of the business or whatever happens to be, a different one of our affiliate agents, to try to keep them in our ecosystem that way.
Super interesting because, as you know, the big servicers are building a lot of technology, including using artificial intelligence to make those offers, not just on the refi, but as people are starting to consider, like you said, second home purchase, investment purchase. So I imagine that is a real back and forth negotiation when you enter into subservicing relationships.
Yeah, and again, these aren't subservicing, right? I'm selling it. So
Yeah.
I basically lose my ability, but I can redeliver the loan to them, which is helpful as I originated. And plus my conversion, where I have a local mortgage consultant as well as a local agent, is going to probably outstrip a lot of times what they can do through kind of a, I would say, bifurcated scenario where it's usually a direct to consumer type loan originator, and then a real estate agent that's in their network. We're just going to perform better. So we have a pretty good, I would say, case around why this makes sense for them.
So you're a former trader and capital markets executive. I imagine that means that you stay pretty close to mortgage rates data. Also as CEO of a mortgage lender, it probably makes sense to stay close to rates. What does your crystal ball tell you about rates in 2025?
Stubborn. The biggest kind of, I would say, telltale sign that I've seen is my whole time coming up through this business, right? There were certain things that would trigger instant precipitous drops in rates, right? And I would say one of those things would certainly be a war in Eastern Europe, right? So like not really anything that ever came on the radar. I don't think anything I ever like thought as a possibility of like this is clearly an event that could happen, but clearly should have taken that, a little bit more on the table. That didn't happen, right? So all of a sudden you see a persistent war. Rates were very stubborn. It was easy to explain it off by saying, hey, inflation is so stubborn. But now inflation kind of regulates a little bit and we see missiles flying throughout the Middle East. That would have been probably, next to a 9/11 type event, one of the big ones that would have moved markets in an absolute race or flight towards, safety in terms of bonds that you could possibly see. And again, rates didn't really react the way that they are, which means, there's something fundamental and structural probably going on in keeping rates a little bit higher than you'd think. I think that combined with kind of, very, very, very potentially deficit inflating policies coming in, I think, and again, I don't know if they are going to be or aren't going to be. I don't know if there's going to be offsetting. I have no idea. But I think that just, unless something breaks in terms of, hey, real deficit control, I think it would be really, really hard to see rates go anywhere into the fives next year. Now, listen, could an administration come in and really pump cash into interesting spots, very specifically targeted to lower mortgage rates potentially? I think that's more the Fed's doing than it would be, the government, but would they be able to influence that? I have no idea. Right. But I don't see structurally from a bond market perspective, really a really strong case or like what's going to be that driving factor to really drive rates, below 6%. But I hope to be wrong. How about that?
Yeah, I'm with you. And I also hope to be wrong, but it doesn't feel like we're getting out of the sixes unless we go into the sevens. That's kind of the direction that I think
I'm not going to be a
out of the
pessimist
sixes.
like that. I'm just going to say, hey,
Justin, really great to catch up with you today and learn more about the business model and why you're doing such a great job on the purchase mortgage side. Thank you so much for joining me today.
Hey, thank you so much, Diego, for having me. Appreciate it.